Good afternoon, everyone. Thank you for joining us. I'm delighted to be moderating our next panel, The New Generation of Private Wealth. I look forward to hearing our panelists' insights on the future of wealth management in the region. Allow me first to introduce our esteemed panelists. We have Yusef Al-Yusef, Global Head of Distribution at Investcorp, a leading private equity firm in the region and globally. We have Philippe Amarante, Managing Partner for the Middle East at Henley Partners, the world's largest firm specializing in residence and citizenship by investment. Before we dive into these discussions, here's a bit of context about today's topic. Globally, family offices, which manage the investments of ultra-high net worth individuals, are now some of the fastest growing sources of wealth. A recent Deloitte study estimates that there are around 8,030 single family offices globally with an estimated value of assets under management of $3.1 trillion. This is expected to reach $5.4 trillion by 2030. To put things into perspective, the assets under management of the hedge fund industry stands at $5 trillion. As for the Middle East, there are approximately 290 family offices, up from 250 in 2019, and this is projected to reach 350 by 2030. The estimated value of assets under management of family offices in the Middle East stands at around $160 billion. So let's dive into the dynamics shaping private wealth management and the evolving preferences of the new generation of family offices. Thank you so much for being with us. My first question to you, Philippe, why have we seen a rise in the number of family offices in the region? What are the main objectives of family offices in the region? Is it wealth preservation? Is it risk management?
Good afternoon, everyone. It's not only so much that the number of family offices are rising. There is a global rise of private wealth. There is a global rise of more people just getting healthier and wealthier at the same time. And I think family offices at a certain bandwidth of your private wealth becomes just a key instrument to manage the estate. So the increase of family offices is just a reflection of what we see globally right now, the rise of millionaires around the world. Now, what is interesting, and I guess for this conversation in the context, is does their, let's say, management habits, their investment strategies change? And that's where we as a firm serving those family offices and their advisors, yes, we do see certain changes happening. And I guess one of the drivers...
Because of the new generation?
Yeah, exactly. So there's more and more younger people, more and more next generation taking over the management of these family businesses, right? And they have a different consumer habit. They have a different investment appetite. They have a different understanding of a globalized world. We have to keep in mind that that generation actually is knowing the world, or does know the globalization as it is, to be able to be connected to every part of the world within a finger click. So whilst the globalization and the global world we live in, we heard this often over the last 2 days, is changing rapidly, there's more and more complexity added. And the only way to overcome complexity is to add more complexity. So that's the mindset of these family offices, these family businesses. So they come in with a diversification by design approach. That's what we see. And it's not so much anymore just about wealth preservation, which at the end of the day at a certain bandwidth is maybe your key objective. It's not so much about wealth accumulation, but exactly that formula is changing right now. The next generation is maybe a little bit more interested in diversifying their investment spectrum. We talked about this earlier, impact investment, climate change, social impact. All of these things matter much more than maybe the more traditional family office interest has been, as we're accustomed to. So we as service providers, as practitioners, we also have to accommodate and actually tailor for that.
They matter much more, but are they actually increasing their investments in things related to ESG?
100%. It's ESG. I made the joke before. Was maybe a bit of a nice to have, a bit of a marketing claim 20 years ago. it's now an absolute requirement in any strategy or investment strategy that you apply and that you deploy and that you design. But it goes even further than that, right? That generation that we are talking, that specific audience that has a deep drive for ethical leadership. Things have to create social good. Things have to have a positive impact on the world, much more than just the profits on the estate, right? And that's where practitioners or people servicing these family offices have to come up with the right products. The regulators have to provide the right regulatory frameworks in order to cater for these demands.
Yusef, what are your thoughts here? We are currently in the third or second generation of wealth when it comes to family offices in the region. Did you see a shift when it comes to investment strategies or investment priorities?
So good afternoon, and glad to be here. I definitely agree with Philip. There is the increase in the number of family offices is a reflection of the maturity of the merchant families in the region and the increased sophistication. And there is a need to kind of focus on professionalizing the management of the family wealth and what have you. We do see a strong focus on SRI, socially responsible investing, impact investing. We do see growing interest in ESG strategies. What's more, I want to say, what's specific to this region is the focus on the Sharia compliant investments as a way, the region's interpretation of the ESG principles. Ethical investing, investing for the good of the humanity, and we've basically aligned ourselves as a GP, as a global alternative investment manager, to cater to the needs of the next gen, who tend to embrace technology, value, impact investing, want to be a little bit more active in the way they manage the relationship with their GPs.
And so have we seen a shift towards active investments compared to passive investments previously in family offices in the region?
Family offices tend to kind of handle their investment portfolio in buckets. So there is the passive bucket and there is the active bucket. The active bucket could be direct investments where the family itself is in charge of managing the investment and in charge of post-AC. And it could be also in the form of co-investment where the merchant family would partner with the GP, to help drive business and add value to the investment. In our case, all the investments that we've done here in the region were in the form of partnerships with established family businesses.
Philippe, it's interesting to look at the family offices in the region. They were mainly embedded within the family group. And their investments would usually be concentrated or related to the line of business of the family group. However, we are seeing now more family offices being separated into separate entities. Do you think this is a trend in the region? And what kind of opportunities does this open for family offices?
Yeah, I think it is a trend, and I would refrain a little bit from trying to compare every family office, against each other. But as a trend line, certainly, and I guess the key drivers are, again, come back to a little bit diversification appetite. It's also, yesterday we heard on stage the great word of the recalibration. I think, without going too much into the topic of the pandemic, but it sort of opened the eyes for a lot of people who hold large assets. Because at the end of the day, you want to remain very mobile and very sort of reactional with your estate, and you will go where you find the right frameworks, where you find the right partnership. And I think that is maybe the decision-making driver behind the movement of family offices and their assets. And that's not always the same. Family offices might go somewhere, but it doesn't mean they lift and shift their entire estate, and take it with them. So it's about finding the right, I guess, environments where these family offices do also feel that the estate is safe, where they feel they are treated as partners, where they feel that the resilience that we talked about yesterday is not just a word, it's actually tangible and can be experienced and used as a tool for the wealth preservation. And we see in the region particularly some of the neighboring countries doing very well in defining the right policies, the right legal framework that is just appealing to these family offices, and therefore, are in global competition. And that's why you have this little bit circus going around where you see on Bloomberg so many family offices relocating from Hong Kong to Singapore, so many from Singapore to Abu Dhabi or Dubai, and vice versa. And I think that trend will continue because it is just about diversification and just spreading out as far as you can without getting too thin.
So currently family offices in the region are mainly based in the region, their family offices.
Yeah, so you have both. You have family offices who are strongly linked here to the region. Again, family offices sometimes are different. You have family offices that have a more traditional, more conservative approach still, even though the next generation is coming. It's a fine line sometimes between the family values and tradition and openness or radical change, right? One of the reasons why maybe there is a carving out sometimes of the family offices out of the enterprises to be a little bit more nimble, maybe a little bit more risky, maybe a bit more risk-taking. But I wouldn't compare everyone, against each other. There are family offices here, but you also have a lot of family offices registered outside.
And how can like hubs, like for instance, you mentioned Abu Dhabi, which is not only attracting the regional players, it's attracting the likes of the family offices of Ray Dalio and others. What can other hubs learn from Abu Dhabi?
I think other hubs can learn from the region. It's also Bahrain, does find its USP, I think, on the map and has an attractive value proposition. Maybe not so much yet directly to the family offices, but to wealthy people. And let's not neglect those, right? The ultra high net worth clients who are maybe not of the size yet of a family office still can provide large economic impact. And countries are on hunt for these people. One of the reasons why we hear the golden visas left, right, and center is because governments around the world understand if they provide a very easy, a very consumer-friendly, investor-friendly journey, it really can make a difference. And those wealthy clients, family offices, ultra high net worth clients, they will choose where they go to, for getting most for their buck, and where they're again treated as partners. So it's not so much anymore purely a numbers game. Obviously, numbers do matter a lot, but it's about lifestyle choices. We hear a lot the word longevity, healthcare, retirement, education. So having access to these markets within a market, within a city, within a country, are at the moment the key drivers that we see.
Yusef, something that interesting Philippe mentioned is where to establish these family offices. And I want to ask you a question. After the Ukrainian war and after the freezing of assets of Russian billionaires, do you think that family offices in the region are more inclined towards establishing their offices and keeping their investments in the region? Do you think this is a risk that they are considering?
Without a doubt. I mean, the region is attracting foreign capital, both institutional as well as family offices. The region is probably one of the few bright spots in the world, that offer, low taxation, benefits, stability, and what have you. So we do expect the number of family offices in the region to grow by about 8 to 9% annually over the course of the next 5 years. We do see a lot of interest, from business families in Asia, particularly Southeast Asia, to invest in projects in the Gulf, and to be more specific, in Saudi Arabia. So, one thing that's clear to us that the market here has matured. The business families are becoming more sophisticated. They understand the value of partnership. they're okay with taking, their companies public. You look at Saudi Tadawul, there are so many family businesses that are listed on Tadawul, and it's perfectly fine. The size of projects that the region, offer would make it difficult for any single family to work alone without, the support of professional investment managers or other families.
But it's interesting what you said, because now if we look at the numbers, still 5% of the investment in equities, if we just look at the equity side of family offices, just 5% in emerging markets, and the rest is in the developed markets and mainly in the US. So previously we didn't have these developed stock exchanges. Now things are looking way better, and especially in Saudi Arabia and Tadawul. So do you think that this allocation to equities will be more inclined towards the local exchanges, or due to the risk diversification, still family offices would like to have their investments abroad?
The majority of the family offices in the region, adopt a very balanced portfolio. They allocate to public equities, to public market strategies in the region and globally, but also we see a trend for allocating more towards private markets strategies, primarily private equity, infrastructure, and private credit. The region is developing, with the support of the GCC governments and the transformative economic visions. We see a solid case for family offices as well as for GPs to invest in local infra, to invest in private equity investments. So the region is maturing, and I do expect the allocation to the region to grow over the next 3 to 5 years. I mean, it's clear within the Gulf itself, people are kind of recalibrating their investment strategies. We see a trend where people are kind of, reducing their allocation to emerging markets and increasing their allocation to the region. So, very, very confident that the future is bright for the GCC.
Yusef, it's interesting what the numbers tell us, especially for your sector, the private equity sector, that family offices, their allocation to private equity is much higher than the global average in the region. They allocate 28% of their portfolio to private equity versus a global average of 22%. This is all from UBS family office report. Another notable difference, Philippe, is their allocation towards real estate. 15% in the Middle East versus 10% globally. Why do you think that?
Well, I think traditionally real estate in the region is just seen as a solid, like literally solid investment. And I think also that looking, back historically a little bit, those stories of, the wealthy Saudi families owning, a couple of townhouses in Belgravia, there's some substance to it for a good reason, because back then, real estate, particularly let's say in the UK or other trophy asset jurisdictions, actually were very strong, growth components. Now that is changing a little bit. So I would expect that you see maybe somewhat a balancing over the next couple of years here, but in principle, always also, in terms of product availability, investment availabilities, real estate here in this market is seen as a very nice and accessible asset class. And you look over to UAE or Dubai, particularly some of those large developers. I mean, it's just crazy, right? So.
And which markets outside of the region are they looking at? And do actually family offices care much about investing for residency?
They do. They do. As practitioner, that's a conversation that we see rising every single day. Those family offices, those wealthy clients, they have the choice, right? They are wanted around the world. Governments are, as I said before, are really trying to incentivize their relocation with residencies, with citizenship, with tax incentives, with access to healthcare, to education, various things, a reduction of red tape when it comes to the structures, etc. It's something that ADGM and DIFC are doing very, very well, I guess. So they can choose where they go, and I predict, or what we see at the moment, they will go where they can see most of the boxes required being ticked right now. And as from a market perspective, obviously, even though economically it's a bit dull, Europe is still very much in demand, particularly Spain, for instance, and Malta. We see large interest also for the US. Let's say maybe not so much out of this region, but India is not far away from here. Huge appetite to invest in the US and establish there as well. So that's still something going on. But in reverse, we see US clients, British clients, German clients, French clients looking to bring a state here in the region. So that's the opportunity.
It's interesting that you mentioned the US, and I've just noticed your tie. Is this a political statement that you're doing just a day before the election, the red tie?
It is a political statement, but not that you think that way. It's obviously an honor to our host country that we're here, an honor to the colors of the Kingdom of Bahrain, red and white. But on that topic, I think what is interesting for us as a firm, we're 450 people globally, 60 offices, but over the past 4 years, we have opened 7 offices in the US. Because what we do, the line of service for our clients, the legal work that we do, the advisory, is just very much in demand in the United States. And I think that is maybe a little bit, the narrative that is for tomorrow. Let's see.
But do you think Trump 2.0 will be better for your business, especially that he's promising to, I think, remove all taxes when it comes to people working outside of the United States?
The beauty about our business is that we are truly agnostic on that. Whether it's left or right, some people might disagree with how the country will develop, and they will come to us and seek alternative options, and then we will say, invest in Bahrain.
Mr. Yusef, what do you think? I know this is a U.S. election. However, it does not only affect the U.S. economy, it affects the global economy with the different policies that we might see from a Trump presidency versus a Harris presidency, and that can affect the flow of capital around the world. What do you think a Trump 2.0 means to investments?
Well, we think the U.S. Is run by institutions. It's not really run by the president, whether it Mr. Trump or Mrs. Harris. The U.S. is truly institutional, market, and the rule of law is there, and very clear policies. As a matter of strategy, we tend to shy away from investing in regulated industries. Hence, we're not that exposed to the political risk. We invest in defensive sectors, sectors that can, perform regardless of the cycles, and therefore, for us, it's really business as usual, whether Trump wins or Harris.
Some believe that a Trump presidency, given the tariffs that he's aiming on different goods, whether it's from China, 60%, or from other countries, other goods imported from other countries between 10 to 20%, this can translate eventually to higher inflation, and this can translate eventually to higher interest rates. Philippe, what does this mean to investments in fixed income, especially that's what's interesting also in the region. We have seen a much lower portion of investments from family offices in fixed income compared to the global average.
I think in terms of numbers, I guess Yusef is much more placed to say, but I think what is important here and what we hear in the boardroom with our clients is the psychological effects of these conversations, right? It's about sentiment, I guess. It's about having a positive attitude and a positive outlook. And what these clients, these investors are looking for is certainty. We heard rule of law. They want reliability. And, looking into, let's say, the development in Europe and looking into the political leadership evolvement we have in Europe, that also transcends into economic decisions and certain policies, that's not providing reliability. That's not providing certainty. That's basically changing policy left, right, and center like other people change their socks. So with the US, I wouldn't be able to make a forecast, but what I do hear is that, they better have a steady hand on things instead of being very tactical, and keep changing certain things and making bold statements that are going through like shock waves, and the tariff ghost is already, around the corner. So I'm not sure, I'm happy to hear what he says, but I think there will be a little bit hesitation, probably, because dust has to settle, and again, capital doesn't like surprises.
We see a world where alternative investments are becoming mainstream. So people are kind of reducing their allocation to fixed income and public equities, increasing their allocations to alternative strategies like private credit as a quasi fixed income strategy, to CLOs again as a quasi fixed income strategy, to PE as a quasi or replacement for public equities. And we also see growing interest in long duration infrastructure projects as a way to provide investors with a steady income, steady return over an extended period of time.
Yusef, how about the openness to invest in digital assets? There's a survey done by Goldman Sachs. It showed that a greater portion of family offices are now invested in cryptocurrencies. The ratio stands at 26% globally versus 16% in 2021. However, what's interesting also in the survey, 62% are not invested and not interested in investing in the future in digital assets. This compared to a much less lower number at 39% in 2021. How do you explain that? How do you evaluate the openness of family offices in the region to invest in digital assets, especially that now we have ETFs on cryptocurrencies on regulated platforms and exchanges?
Great question, Lara. I think we have to differentiate here between cryptocurrencies and blockchain technology. When it comes to blockchain, we do see the demand, the interest to understand the blockchain, technology and what it offers to as an investment strategy. People are less. I want to say, people are quite skeptical about crypto, but very, very interested in allocating to blockchain strategies, including digital assets, especially with the next gen. I consider myself as a digital immigrant. Next gen are digital natives. I mean, that's why the way I look at digital assets is very different from the way the next gen investors look at the blockchain strategy. And now the blockchain has become part and parcel of the technology vertical. So when people talk about allocating to technology, public or private, blockchain is becoming a key component of the investment strategy.
Philippe, are your clients interested? Do you see an inclination from your clients toward digital assets?
Yeah, of course, with different speeds, I would say. Not every one of our clients is as tech savvy as maybe they think they are. But yeah, it's not only when in terms of the private client advice or the private client practice a conversation. It's also a conversation when we talk to sovereigns and rights holders and governments around the world, because they also want to get a grip on that, right? So the question would be, what can we do as a government or as a government agency? What regulatory framework can we create in order to tap into this market? Because that's not going to go away. It's going to stay and provide an enormous opportunity for wealth creation, wealth preservation, and more value will be created in those spaces. Hence, why governments and sovereigns would like to get a hand on it.
Thank you. Let's end this conversation. I want to hear your thoughts on one thing. Looking forward in the future, what worries your clients the most from family offices? Is it geopolitical risk? Where are their worries? Yusef.
Geopolitics is definitely a factor, But when it comes to the family offices in the region, they do understand that we have wise leadership. The leadership in the GCC, was successful in kind of isolating this region from all the regional conflicts. We've been through so many conflicts in the last 50 years, and the region continued to prosper and grow. So it's a concern, but it's not that big of a concern.
Philippe?
Yeah, I second that. Maybe, excuse me, looking outside the region, the confidence in political leadership is something that's a strong concern. And, I think there are certain key markets that have been very strong pillars in not only in global economics, but also, geopolitically, giving good hands, good advice, keeping places and things in order, but they're struggling right now. And these markets, these forces for good appear to be weak, managed weak, and again, that's a concern of these wealthy clients. If they have alternatives and they can go somewhere else where they have strong, consistent, reliable, wise leadership, obviously it's not a conversation anymore. Right?
And in one word, what's the biggest theme for investments for family offices in the next 5 years? Will it remain AI? Yes or no?
Yes, definitely.
So more allocation to the US since the big players are still American companies.
AI and infrastructure.
Philip, do you agree?
I agree partially, but I think that AI will also find its way outside the US, and we see already stuff
Europe.
happening.
In Europe?
Maybe this region can become
Or China.
a very...
Wow.
Yeah, no, I think this region can be a very interesting player at the table when it comes to AI moving forward.
Philippe, Yusef, thank you so much.
Thank you.